Hey everyone, thanks to everybody who's after joining the webinar so far. My own name is David Looney, and I am joined by some of my colleagues here today as well from Alpha Wealth, including Lorna McHugh, who is a fellow financial advisor here in Alpha Wealth. Um, so if anybody does have any questions throughout today's webinar, look, please feel free to pop them into the chat box and we'll allow a bit of time throughout the webinar to address those questions, as well as a bit of time at the end, of course, and people are more than welcome to link in with us after the webinar as well if they want to discuss anything on a one-to-one basis. So today's webinar is naturally on redundancy. It's something that we've been very busy with in AlphaWealth over the last couple of years, just based on how prevalent it is with so many major Irish employers and even indeed smaller employers announcing layoffs. We've done quite a lot of these redundancy webinars over the last couple of years. Look, and we just thought it was important to keep doing them just based on the more and more redundancy announcements that are out there within the media. Um, so I suppose when it comes to redundancy, it's not always as simple as just getting a bit of a lump sum. It is an ideal time really to review your financial situation. Sometimes you do need to assess whether maybe you can afford to take a bit of time off work if it's a voluntary redundancy, if it's a forced redundancy. Again, maybe it's a good time to make some kind of tweaks within your financial situation to plan for that time with being off work. And the redundancy package itself then is, look, it's a bit of a complex process. It does involve reviewing your entitlements and your options, and there's some very important decisions to make. And then beyond that, it's about, what do I do with my pension? What do we do with our redundancy monies, of course? And maybe if people are out of work for a certain period of time, or indeed maybe moving into a role with maybe a lower income, you really have to consider what implications that has on your kind of wider financial planning journey, and what steps you should be taking now to maybe address that. So look, hopefully over the next kind of 40 minutes or so, we'll be arming you with all of the information to make more informed decisions throughout the redundancy process and with your kind of wider financial planning as well. So if anybody is on our webinars for the first time, just to quickly introduce you to Alpha Wealth, we run an independent financial planning and advisory company based out of Little Island in Cork. Although we have 17 advisors now throughout Ireland to provide straight talking financial advice to individuals and families like yourself. All our advisors are highly experienced and qualified, and we've been in business now about 12 years. And over that period, we have over 4,000 clients from all around Ireland, as well as assets under management of over 400 million. So we have quite a lot of experience, helping people to manage their money more effectively, and plan ahead financially to meet all of their financial objectives. Just in terms of today's webinar, the main points that we're going to be covering, firstly, we'll be looking at what you're entitled to and how is it calculated with respect to severance or redundancy payments. We'll be looking at the tax options around your lump sum and how it impacts your payout and your retirement benefits. We'll then be moving on to how to reduce or offset some of that tax on your redundancy payment. And finally, just to wrap it up with some kind of wider financial planning and retirement planning advice, because there are some considerations there as well when somebody's going through a redundancy process and indeed leaving an employer. So if you are at the prospect of losing your job or being made redundant, there is three vital steps that I think people should consider doing next. The first is possibly to engage a solicitor who specializes in employment law to help them basically navigate through that process and negotiate with the employer and just basically make sure everything is above board. I've had a lot of clients that have engaged a solicitor through that process, and they found it really, really helpful just to make sure that there's somebody in their corner, and they're getting everything that they are legally entitled to. Without blowing our own trumpet, number two is meet with a financial planner. I think this is really important, as I said, just to assess your current financial situation, your income needs, your expenses. Sometimes it's a case of making some tweaks to plan for time being out of work. Review your savings, your tax position, your pension, and your redundancy package to make sure that the figures are correct. You're taking the right options with respect to your redundancy payment, and obviously assessing the financial impact longer term for you. And thirdly, if you're not moving immediately into another role, it is important to register as being unemployed with the local social welfare branch to claim a benefit called Job Seekers Benefit. So job seekers benefit is basically a weekly payment for people who are, either seeking employment or have just lost their job. You qualify for it if you're under 66 years of age and are looking at a substantial loss of employment, which is defined as an employment of 4 days out of 7 days a week. And you obviously have to have enough social insurance contributions or PRSI contributions. It is a payment which generally lasts 6 to 9 months. It was actually increased in recent years to a maximum payment of €244 per week, as well as an additional €162 per week for a qualifying adult dependent. So let's say if you had a spouse that wasn't working as well at the time of you being made redundant, you would get both those figures together, and there can be additional weekly payments then as well if you have children. The max payment here on screen would be based on if you were in an employment earning over €300 per week. If you're earning less than that, it would be scaled down. Now, just to note that depending on the total net value of your redundancy package, you might be, I suppose, disqualified from applying for job seekers benefit for an initial period of 1 to 9 weeks. The max wait period is 9 weeks if you're going to come out with a sum of €90,000 or more, and anything less than that, it will kind of go down on that scale. So between kind of 50 to 90,000. There is an alternative to job seekers allowance for people who might not have enough social insurance contributions or might not qualify for job seekers benefit under some other grounds, and that is job seekers allowance, and it is a means tested payment. But there's some really good information on sites like citizensinformation.ie if anybody needs some information on either of those benefits. So if we look at a redundancy package in itself, it is broken down into a couple of different elements or aspects, and it's important for you to kind of know what each one looks like. So firstly, you do have something called statutory redundancy, which is like what you're legally entitled to if you're being made redundant. It is offered to people who are in service for more than 2 years. It is a tax-free payment, completely tax-free, and it's calculated as 2 weeks gross pay for each year of service plus 1 additional week's gross pay. However, the gross pay is actually capped at €600 per week. So if you're earning more than that, essentially it's €1,200 multiplied by your years of service plus €600. You then have something called ex gratia redundancy payments, which is kind of like up to the discretion of your employer. It's usually an incentive-based payout, maybe based on a multiple of your weekly earnings, let's say 4 times your weekly earnings by your years of service. Part of that can be tax-free and part of it can be taxable. The part that is taxable will be subject to your marginal rate of tax, so either 20% or 40% income tax plus USC and PRSI. Obviously, the tax rate that you're paying now will be based on your overall income in a given calendar year or a tax year, inclusive of your redundancy payment. So if that's overall over €44,000 a year, you are going to be up in the higher rate of tax of 40% plus USC and PRSI. So you're looking at an effective tax rate of about 50% there. But thankfully, there is some generous tax-free allowances on redundancy payments, which I'll be getting to in a while. Just to mention as well that sometimes a package can be inclusive of statutory, or sometimes it can be exclusive of statutory. So basically, sometimes your employer will say, look, we'll give you, let's say, 100,000, and then they'll take statutory off that. But then sometimes they'll give you 100,000 as well as statutory, let's say, as an example. You do then have things like, payment in lieu of notice, pile-on, holiday pay, or any accrued bonuses. Those guys usually just go through your final pay slip in the normal manner. There is no tax exemptions on them, but it might be possible to shelter some of those payments in your pension as a last-minute kind of pension payment, which we'll be addressing on the webinar. And then you might have certain discretionary payments to maybe reimburse you for any professional fees that you needed to pursue while you were going through this process, such as a financial advisor, a planner, a solicitor, or a tax advisor. So just so it resonates with people, I always think it's helpful just to look at some numbers based on an example. So if we look at an example case here, a 35-year-old Mary Murphy, she's earning a salary of €80,000 per year. Her earnings over the past 3 years were 71,000, 76,000, 85,000, so an average of 77,333. Why that 3-year average is important is because it features in one of the tax-free exemption calculations, which we'll be looking at in a second. She had 12 years service in her company, and her pension value is 92,000. And the present day value of her pension tax-free lump sum is 23,000 based on 25% of the fund value. Again, there are things that will feature in the tax-free exemptions. So if we look at the statutory redundancy, we're looking at a payment of €15,000 based on that calculation there. All of that is tax free. And then an ex gratia payment will just take a typical example of, let's say, weekly earnings by 6 by years of service. And that would give a overall figure of €117,720. In this example, we'll assume that the ex gratia payment is exclusive of statutory, so she's getting both together. So as I mentioned, part of that ex gratia payment can be exempt from tax and part of it can be taxable. And it really boils down to a series of three calculations with the highest answer equaling how much of your payment is tax-free. So you mightn't always need to go into, I suppose, as much detail as, what's under the bonnet within these calculations. Sometimes it's a case of your employer saying, look, do you want to take option B, which means this, or do you want to take option A, which means this, or do you want to take option B, which means this? But I think it's important for you to know what is going on in the calculations just so you can see what you're entitled to. And of course, we would encourage people to have these, I suppose, calculations and estimates verified by a third party, which we can obviously do for you as a financial planner. But the three calculations that they would be running is, firstly, there's something called a basic exemption, and how that is calculated is it's €10,160 in addition to €765 for each year of service. With that one, need to there's no need to sign a waiver giving up your right to a pension lump sum on retirement, whereas that is an option that you have to consider on the other two exemptions, which we'll be looking at now. Sometimes if, let's say, a basic exemption absorbs all of your redundancy payment, let's say if I had an employer who was offering me €10,000 as an ex gratia payment, we can see fairly easily that the basic exemption would absorb all of that. So naturally, I'd be going with the basic exemption, and I wouldn't really need to get into a decreased exemption or a standard capital superannuation benefit. If it was higher than that, there is something called an increased exemption, which is basically the basic exemption plus €10,000. You can only use it if you haven't received an increased tax-free exemption on a redundancy payment in the last 10 years, or are not about to draw down your pension. And if you do use the full increased exemption, you would have to sign a waiver, which would forfeit your right to access a tax-free lump sum from your pension on retirement. The third exemption, the one that is most widely used, particularly for people that are on kind of, higher earnings or have been in their companies for many, many years, is something called the Standard Capital Superannuation Benefit, or SCSB for short. And how it's calculated is your average earnings for the past 3 years multiplied by your years of service and divided by the number 15. Now, there's kind of two variations of the SCSB. One is using the full exemption, and that involves signing a waiver. The second one is that you subtract the current pension lump sum value from your pension, therefore reducing the exemption figure and making more of your payment liable to tax. And with that one, then you don't have to sign a waiver giving up your right to a pension lump sum. So it's kind of a case of saying, do I want more tax-free now or more tax-free down the line when I go to draw down my pension?
David, I might just jump in on a question there.
Yeah, please do.
You mentioned about potentially waiving the right, depending on your options, for taking tax-free funds from your pension. Is that relating to just the pension in question, or is that relating to all pensions?
Great question. Yeah. So the waiver only extends to your current employment pension. Any pensions that you have knocking around from previous employments, or indeed any pensions that you will generate in subsequent employments, aren't affected by signing a pension waiver. Perfect. Um, sorry, just to backtrack very slightly there as well. Sometimes you can have a case, as I had for a client very recently, where the reduced SCSB exemption, even when taking the pension lump sum away from the calculation, absorbed all of their redundancy payment. And in that case, you might need to get into these options, because like if basically your employer might employ certain companies to run these kind of figures. And if it's a case where they can confirm that all of your payment is tax-free, then you might not need to, I suppose, tick any options or sign any waivers or anything like that. So some people might be in that bracket.
I just have one more question, David, before
Yeah.
you move on. Option three, so the SCSB, is that just with, say, your base annual salary, or does that include any commissions or bonuses that you've earned?
Yeah, it can actually be total remuneration. So it could be, I suppose, your salary, your bonuses. I have even seen cases recently where they've taken kind of awards of shares, so shares that people have been given through their employment into the total remuneration, because obviously the higher you can get the remuneration, the better, because the higher the exemption is going to be and the lower amount of your redundancy payment would be subject to tax in that case, or ideally none of it. But just looking at how those exemptions would apply to Mary Murphy's situation that we looked at earlier, we've already kind of been through her details, but her package, just to remind you guys, was €15,000 statutory plus 117k thereabouts ex gratia. So the basic exemption would be €10,160 plus 765 multiplied by her 12 years of service, which would give a figure of 19,340. So that's not absorbing much of that 117k, so there's going to be a lot of tax there. The increased exemption is 10 grand slapped onto that, so that's 29,340, but involving signing a pension waiver. The SESB exemption, so that's the average earnings we looked at, multiplied by her 12 years of service, and divided by the number 15, is 61,866, but having to sign a pension waiver. And then there's the reduced SCSB, which is the 61,866 figure here, minus the pension lump sum value, gives a reduced figure of 38,866, but not needing to sign a pension waiver. Now, with respect to the pension lump sum value, there's two ways to calculate that. The simple one is 25% of the fund value, so 25% of your pension. And why that is that when you retire your pension down the line, you are entitled to take 25% of it as a tax-free lump sum. However, there is another calculation that they will use, which is called a salary and service lump sum. And as the name would suggest, it's based on your salary and service, and it's done up by actuaries. We don't know what that is in advance because it needs to be calculated by your pension scheme actuary. So for these examples, we'll just assume 25%, but in reality, they will probably run both. And obviously the lower amount should be used, because then it'll, I suppose, not reduce the exemption figure by as much. So that's something to look out for as well. So if you look at this case, we're looking at an exemption of 61,866 if we're signing a waiver, or 38,866 if we're retaining our right to a pension. So in this case, some of the redundancy is still going to be subject to tax, irrespective of what option we go with. The net payout that we're going to be looking at, option A, is 676, or keeping the right to the pension lump sum, a net payout of 91,716. Where I'm getting that basically is it's the ex gratia figure minus the exemption, tax applied to the balance, and then the statutory payment added back on. So there's basically a difference of around kind of €12,000 into your back pocket, or Mary's back pocket, depending on whether she goes with option A or option B. So the big question for her, as might be the case for many people on the call if they are looking at redundancy, is it really worth it signing the pension waiver just to get an additional roughly €12,000 now? The great thing about pensions that a lot of people forget is they benefit from tax-free investment growth. So if you, let's say, leave a company now with a pension pot of 92,000 and that's invested appropriately, there's no reason why it can't earn, somewhere between 5 to 10% per year between now and retirement. If we took, let's say, a 6% growth rate now for 25 years to get Mary to 60, her future pension fund value would be worth about 394,000. And at that point, as we said, she could take 25% of it as a completely tax-free lump sum, which would be €98,713, assuming she didn't sign the waiver to that. That gives somebody a lot of options at that time. They could use it to clear their mortgage or clear their any outstanding debt to set themselves up for retirement, maybe put it towards buying a holiday home or using it to travel. So for the sake of losing out on that, I suppose, windfall down the line, is it really worth it just to get maybe an additional €12,000 now, when you're going to be getting maybe €92,000 at a minimum anyway with the reduced exemption redundancy option? The right answer really will depend on your personal it will depend on your personal circumstances and your own numbers. Um, I would urge people to get some professional advice. It's a big decision that you have to make. Please do not ask your colleague what they done. I have seen some horror stories of people doing that. No two people's financial situations are exactly the same. Even if you're in the same company and you're earning the same as your colleague, your situation and your needs and your goals and objectives outside of that will be completely different. And it's really your wider financial picture will, I suppose, determine what the best option for you is. And hopefully you can come to that with some good advice. Now, if there is quite a significant difference in the package, let's say there was €20,000 in the difference between option A and option B, one thing I do encourage clients to consider is this loophole that people talk about. You might have heard your colleagues refer to this. It's basically born out of an anomaly within current pensions legislation. It is currently within the rules. It's something the Pensions Authority and the Revenue are well aware of. I've used it for many clients. I've transferred their pensions into this PRSA, which I'll talk about in a second, brought them up to retirement and still got the pension lump sum. But how it works basically is you take the higher amount of your redundancy payment now, sign the waiver giving up your right to take a pension tax-free lump sum from an occupational pension scheme relating to this employment, which is what you're doing when you sign that waiver. And then after you leave service, you transfer your pension to a pension vehicle called a PRSA, a personal retirement savings account. Works like any other pension, and you can access it from 60 or from 50 if you're taking full early retirement. Now, there is a requirement to get something done up called a certificate of benefit comparison. It can cost maybe €1,000 to €1,500. It's necessary to get it done by a third party actuary. But how it works is that because a PRSA is quite unique in how it fits into the Irish pensions legislation and landscape, is it's not regarded as an occupational pension scheme. It's a completely personal arrangement which is not linked to an employment. So basically the waiver doesn't follow over to it. And the rules within the pensions system in Ireland are that at the moment, anyone that has a PRSA can take 25% of it as a tax-free lump sum at retirement. There are some risks possibly, maybe if the rules are changed. Personally, I don't think they will be, because the government and the Pensions Authority for many years now have had this kind of roadmap, the pensions reform, where every year they kind of announce certain changes that they're looking at doing within the pension system in Ireland, and changing this has never ever featured in that I suppose on that agenda. What I kind of say to clients is that, like, if there's only a slight difference in I suppose, your package between option A and option B, it's probably something I wouldn't bother pursuing. Let's say there was a difference of €4,000. I'd have to pay 1,500 anyway, maybe, to get the certificate of benefit comparison. So for the sake of 2,500, is it worth taking on the risk? And am I better off just staying where I am, not signing the waiver, and guaranteeing that I can take a tax-free lump sum for my pension on retirement? Again, it really boils down to the numbers and your circumstance, but this is something that I can advise on and indeed assist with if anybody wants to discuss it or indeed pursue it.
David, while we're on the topic of
Yeah.
kind of calculations, does the SCSB waiver include waiving the right to a separate AVC pot that you might have been building up on the side?
Yes, because AVC is linked to an occupational pension scheme in your current employment, so it would.
And in terms of, we'll say, when your salary average over the past 3 years has been used in calculations, what effect would being on maternity leave within the last 3 years potentially have on that calculation?
It could well, it would depend, like whether you were getting full pay for your maternity or whether you took, I suppose, unpaid leave or anything. But like, naturally, if somebody's salary was less in the last 3 years, than it would be if they were working full time, getting full pay, then it would bring the average down. I do believe that there is some kind of, I suppose, allowance for people that are on maternity leave, though, when they are calculating the average. So look, that is something that I would encourage you to maybe look into further, looking at something that I can look into further myself.
Perfect. Thank you.
No worries. So is there a limit on how much somebody can actually get tax-free? Like if I get 500,000 from my employer as a redundancy payment, lucky me, is all that going to be tax-free if the calculations cover it? Unfortunately not, because there is a 200,000 lifetime tax-free limit that somebody can get on all severance payments within their lifetime. Not to be confused, but there is a completely separate 200,000 lifetime limit that somebody can take tax-free from pensions on retirement, unless waived, of course. So one does not reduce the other. I can get 200 grand tax-free from severance payments, and I can get another 200,000 tax-free from my pensions when I retire. What happens when you do retire a pension, by the way, is 25% of the fund or the salary and service lump sum comes out tax-free, unless we sign the waiver. The first 200,000 is completely tax-free, and the next 300,000 is taxed at 20%. So if I had a pension pot of 2 million, let's say, 25% of that would be 500k. The first 200,000 would be tax-free. The next 300,000 would be taxed at 20%. Then the balance would go into something called an approved retirement fund, which is kind of like a fund that I could draw down income from. The approved retirement fund still benefits from tax-free investment growth, very flexible and tax efficient vehicle to have in retirement. Or else I can purchase something called an annuity, which is like a guaranteed income for life. The issue with annuity rates is there's no flexibility in them, and the rates are quite poor. Hence, like I suppose, well over 95% of retirees nowadays will go with an approved retirement fund. But that's something I can discuss with people if they need to. If somebody is start signing a waiver, giving up their right to a pension lump sum, it's worth noting as well that that does actually only extend to the tax-free amount. You still have that 300,000 at 20%, if your pot is, let's say, over, like if it's kind of that high, essentially. So like if I had, let's say, 200,000, 25% of that would be 50,000. So that's within the kind of first 200,000. But if it kind of pushed me into the next kind of phase, you could utilize the next 300,000 at 20%. So that's just something to watch out for people that might have signed the waiver and are then drawing down their pensions, just to make sure that they are offered that. So outside of the tax-free exemptions, there are maybe two ways that you can look to further reduce your tax liability when going through a redundancy process. The first is by making last-minute AVCs. An AVC is just a fluff term for a pension contribution. There's two kind of manners in which you can go about this. One is that you can ask the employer to allocate maybe like bonuses or pile on or some of your last pay, let's say, directly into your pension to shelter it from tax, so it doesn't hit your bank account and it saves on the income tax. Goes into your pension, continues to grow tax-free. But you can also make an AVC from personal funds. So every year somebody has an opportunity to make a backdated pension payment to a previous tax year. So if I say, let's had 15,000 euro in my bank account that I didn't foresee me needing in the very short term, knowing that I was going to get the redundancy payment maybe a couple of weeks or a couple of months later, I could make a 15,000 euro top up into my pension, and then revenue would give me 6,000 euro back when I complete my 2025 tax return or amend it and include that contribution. So it only cost me 9,000 euro to get 15,000 euro into my pension. Pretty good deal. You know, you show me another investment vehicle where you give me 9 and it immediately turns into 15, even before the money's invested. The key thing is it must be done before your last day. And don't forget that pensions can be accessed from 50. So in a lot of cases, this is not tying up money to 65 or 70, like some people would believe. They can be accessed from 50 in most cases. There are limits on how much you can put into pensions each year. It's dependent on your age and your earnings. So if you're in your 40s, let's say, you could put in 25% of your earnings. And if you were putting in, let's say, 5% through regular salary deductions, that would mean that there's another 20% that you could have put in, and you can fill that out basically with this kind of last minute ABC. It is something that I would encourage people to do, particularly if they're going to be suffering a lot of tax on the redundancy payment anyway. And also, if somebody is going to be out of work for a period or maybe moving into an employment that isn't paying them as much, they should really be making hay when the sun shines and tries to squeeze as much money into the pension now to maybe allow for reduced pension contributions in the future, which would obviously have a knock-on effect on their retirement pot. The second option that they can utilize is something called the Employment Investment Incentive Scheme. It's not for everyone and it is a bit left field, but how it would work is, you suffer the tax on your redundancy payment and you put some of the after-tax money into an EIS company or an EIS fund. EIS is the Employment and Investment Incentive Scheme, and it basically allows companies to raise capital. And if we invest in these companies, we benefit from tax relief on the money that we put in addition to possibly money back from the company if they're successful. You can invest with individual companies who are raising capital. They're generally kind of early stage, to be fair. Generally high risk, obviously, which comes with the territory of early stage startup companies. But there are also some good EIS funds where you're investing with I suppose, an experienced fund manager who deploys the capital to maybe numerous companies to achieve a bit of diversification or maybe numerous EIS qualifying projects. But there are different relief rates. So if you're investing with like startup companies, you get 50% of your money back from revenue. If you're investing with kind of maybe early stage or ones that have kind of raised the AS capital in the past, it's 35%. And then if it's like more established companies, it's 20%, which doesn't feature as much nowadays because it's not as attractive. But looking at the numbers, let's say we put €10,000 into a qualifying EIS fund or EIS company, and we were getting 35% relief based on that company or fund, revenue would basically give us back €3,500 as a tax rebate in year one. So it only cost us 6,500 to get the 10 grand invested, similar enough to an AVC. But then if the company is successful, we would be returned our capital plus maybe a return. I've used 30% as an example here, which would be typical. So you could be getting about 13,000 back after maybe 4 to 6 years. Generally, the minimum hold period is 4 years. They can run kind of 6 to 7 years in some cases, but a fairly good return on investment. And it is one of the only vehicles that people have in Ireland outside of a pension to get quite a lot of tax back. We do, I suppose, look at this for our clients every year. As I said, there are loads of companies and funds which are launched kind of much later in the year, which we're happy to talk to people about if it's something that they want to discuss or pursue. What I just want to talk about now is pension options after leaving service. And I can't stress how important this is or how much of an opportunity it is for people. We spoke a lot about, the importance of making the right decisions with your redundancy payment, but this can actually be more important, believe it or not, and I'll show you why in a second. So if you leave an employer, you have a couple of different options with regards to your pension. One is leave it where it is, stuck in the old employer scheme, and you can access it generally from age 60 to 65. Might not suit people because they no longer work for the company, there's nobody managing it, there's a lack of kind of control or transparency. You then always have the option as well to move it into your new employer scheme, which can seem attractive because it consolidates your pensions and amalgamates them and keeps them all under the one roof. But that can be, I suppose, it can put you at a disadvantage as well, because the advantage of keeping pensions separate is you can retire them at different points in time. Whereas if you're currently rolling all of your pensions into the one company pension scheme, you've no access points until you leave or retire from that new company. So if you wanted to facilitate some kind of phased retirement strategy in the future where you went back to maybe 3 days a week and then drew on a pension to supplement the reduction in your earnings, if you had all of your pensions tied up in your current company pension scheme because you kept transferring them in, you wouldn't have that option. So it's not something I would advise. What tends to be the most popular option for people is to transfer it into something called a personal retirement bond, or the PRSA that we discussed earlier, which moves it into your own name. You can access it from 50. The PRSA, obviously, you'd only be pursuing that if you were going about this kind of loophole that we discussed earlier. If you're not doing that, the option would be the personal retirement bond, which doesn't require a certificate of benefit comparison. There's no cost to transferring into it. And there is a fourth option for people who are in their companies for less than 2 years, and they have an option to take a refund of their contributions minus 20% tax. This can be actually quite favorable if you are a top rate taxpayer and you're in your company for less than 2 years. So like, let's say if I was in a company for a year and a half, and I knew I was being made redundant in 3 months' time, I could max out my pension, get 40% relief on all of the money going in, and then just take it back out minus 20%. So everything else being equal, it's a 20% gain. Why I stress that it's important to maybe look at options outside of your company pension scheme is that not all pension funds are the same. And the opportunity you have when you leave a company and its pension scheme is to move your pension funds into maybe better performing vehicles through, let's say, a personal retirement bond. The advantage of dealing with, I suppose, Alpha Wealth or a company like us is we're a completely impartial provider of pensions. We deal with all of the main pension providers in the Irish market, so we've no vested bias in recommending one over another. And as I said here on screen, not being in the best can literally cost you hundreds of thousands of euro. So many people on the call today will be in one of these funds, I take it, okay? Because if you look at some of the main corporate pension providers in Ireland, you have Mercer, you have Willis Towers Watson, you have Aviva, you have Irish Life, you have Aon, who actually use Irish Life funds, and every company scheme has a default investment strategy. The most popular funds within those default investment strategies, these are the ones you fall into if you're not picking your own funds within the scheme, feature here on screen. So you've the Zurich Prisma 5 fund, you've the Mercer Aspire High Growth Fund. If anyone on the call is working with Amazon, you are looked after by Willis Towers Watson, and your pension is going to be invested in the LifeSight Higher Target Return Fund. Aviva, their main fund is called the Multi-Asset Active 5 Fund, and Irish Life, the Portfolio Pension 5, otherwise known as the Empower High Growth Fund if you're in a corporate scheme. If we look at the last 5 years, Zurich's Prisma 5 has returned 78%. The next best, Mercer, 58. Willis Towers Watson, Higher Target Return, 52. Aviva, 47, and Irish Life, 44. So if you're here sitting in an Irish Life pension, which only returned 44% over the last 5 years, meanwhile, Zurich in the same risk band has returned 78% over the last 5 years, I know what I'd be doing if I was leaving the company. Looking at simple maths, if you had 100 grand in your pension 5 years ago, you would have about 35 grand more in it today being in a Zurich fund than an Irish Life fund over the last 5 years. That's not insignificant. So even a slight difference in annualized fund returns can really add up over time with compound interest. If you take 50,000 euro growing at 5% per year for the next 25 years to your retirement, that would be worth a pot of 169,317. Whereas 50,000 growing at 7% per year for the next 25 years, a 2% difference would be worth 271,371. It's a difference of 102,000 guys just on 2% per year. So that's why I stressed earlier that what you decide to do with your pension is actually much more important than how you could draw down your redundancy payment, because your option between option A and option B on the redundancy payment is unlikely to cost you over 100 grand. Choosing the wrong pension or sticking in underperforming funds because you didn't look into things properly will end up costing you hundreds of thousands of euro potentially. So one thing we can do in Alpha Wealth is review your pension scheme for you and see, what the fees are, see what your performance is like, and obviously give you advice as well on what the best options are to do with it after you leave your company. It's also important to consider any other benefits that you might lose. So like death in service, which is life cover, income protection, health insurance. If you are losing any of these benefits, it might be worthwhile considering whether you have to take out any personal policies in the meantime, unless you're moving straight back into another employment just to protect you and your family. Again, we can provide quotes and advice on all of these. We're an impartial broker within the Irish market. We deal with all of the main insurance companies and can discount these policies quite heavily. We're not a health insurance broker, although we can provide independent advice on it. One thing I didn't put in here is shares, which I think is really important, because too often I meet people that are working in companies where their income is tied to the company, their pension is tied to the company, but they also carry a significant amount of their personal wealth in the company share. which is crazy because it's all eggs in the one basket. It's not diversified anymore. And it is, sorry, it's not that diversified at all. And it is a recipe for disaster. So one advice, sorry, one, I suppose, bit of advice we can give people is to, what to do with those shares and how to, I suppose, ring fence the value of them in more diversified options to remove the overexposure to that company. And this obviously extends to people that are still stuck in the companies as well as, leaving them. What I just want to talk about now, and before we get into this, Lauren, I might just see if there's any kind of questions on the previous sections.
Yeah, there are a good few questions after coming in now. Some of them are probably specific and require kind of individual advice. For example, if you are in a combined defined benefit and defined contribution scheme, so for example, we'll say the defined benefit section is now closed, should you look to transfer the defined benefit funds into your defined contribution before leaving?
It depends. I hate giving this answer, but it really does depend on your situation. Sometimes it can make sense to take a transfer value of a defined benefit pension scheme, particularly if they're giving you an enhanced transfer value. Other times not. So I would encourage you to maybe link in with us after, and we can kind of look into that for you. Some scheme rules actually allow you to separate. So you could say transfer the defined contribution pension fund, but keep the defined benefit in the old scheme, but then some won't allow you to transfer one without taking the transfer value of the other. So yeah, look, we can kind of crunch the numbers. There is a formula that I can do basically to assess whether it makes financial sense. People think that defined benefit pensions are like the holy grail and the be all and end all, but they're not always. The the downside of defined benefit pensions is that they don't kick in until 65. And if you want to take it earlier, they're going to significantly reduce that defined benefit pension. So I have a lot of clients that have been offered fairly attractive transfer values. And by moving them into a fund, generating a decent investment growth rate and accessing it earlier, the drawings from that future pot could often be much more than what you'd get from the defined benefit. And also, if you die, 100% of the remaining pot goes to your dependents, whereas with a defined benefit, generally only 50% of the income would go to your dependents. And also defined benefit pensions is fixed per year, whereas the ARF route, let's say, allows you to take more some years, less other years. So it gives a bit more kind of flexibility. So it is really down to your situation in a very long-winded way.
I know we've touched a lot on taxation, but would you mind just reconfirming, please, if you waive the right, does that affect your lifetime limit of 200k that you can withdraw from pension funds, or what does that look like?
No, so like let's say if I accumulated five different pension pots over my working lifetime, and one of those pensions I waived my right to take a pension lump sum from, I could still take 25% of the other four that I have, subject to that limit of 200,000 across all of them. So I hope that answers it.
Yeah, thank you.
Yeah.
Just one last one we might touch on before you get back to the slides. Can you just reconfirm as well? So, if we'll say a particular client has drawn out their 25% tax-free cash and matured their pension, what does the taxation look like for the remaining 75%? There's just someone querying. I know you mentioned the 300k being taxed at 20%. Can you just confirm what the drawdown looks like?
Yeah, so the balance of your funds go into a vehicle usually called an approved retirement fund. And simply put, they just kind of stay within an investment fund. But obviously, if you're in your retirement years, would be investing that a lot more conservatively. But how much income you take out of that fund is completely up to you. So sometimes it's a case of saying, look, how long am I expected to live? And based on projections, how much can I draw down each year so that I don't run out of money? But then you might take more some years and less down the line due to the fact that maybe the state pension kicks in later, so you know you're getting more income down the line versus now, or maybe you expect to be a bit less active in your much later retirement years, so you don't mind taking more now to be left with less later on. But to answer your question, how much your tax will depend on how much you're taking out of the fund. Um, to be honest with you, most people will pay little to no tax on their retirement income because, like, most of us will have much lower income levels in our retirement years than our pre-retirement years. So, whilst we might be paying 40% income tax on some of our income now, chances are we'll be paying a very low effective tax rate on the drawings from like your approved retirement fund or any other pensions that you have, or even the state pension. Also from 66, your tax position is a bit more favorable because you have like reduced rates of PRSI, and you can earn, more up to certain levels without paying tax. So it depends on your overall income level basically to determine the tax rate, but it's kind of back into the 20% or 40% depending on certain levels.
Perfect, thank you. We might touch on the remainder of the questions in a short while.
Perfect, perfect. What I just want to talk about now, guys, is getting redundancy lump sums to work. Because unfortunately, we're pretty bad in this country with getting our money to work for us. So what I definitely don't want people to do is get their redundancy money, stick it into some current account, and 5, 10, 15, 20 years goes by and you haven't done anything with it, and it's just lost a fortune relative to inflation. And it's important to get all of your money working for you. So when it comes to getting your money to work, there is this distinction between, do I put it into a short-term savings account, or do I put it into like a longer term investment account? And it's the time frame really will decipher which one of those vehicles you go into. I do define the short term as maybe the next kind of 4 to 5 years. So it's about kind of looking at money that you envisage you needing within the next 4 years, including a bit of a buffer or an emergency fund. And that amount and only that amount should go into a savings account. So if you've 200 grand sitting in your bank account and you're not going to be spending 200 grand within the next 4 years, it doesn't all belong there. You might decide to put 50 grand in a savings account and the balance invested. I'll show you why that's important in a second. We have about 170 billion on deposit in Ireland today among households, and central bank statistics would indicate that about 130 billion of that is in these easily accessible overnight accounts like current accounts, credit union accounts, demand deposit accounts, which are all earning about 0% per year. The average rate is actually about 0.13% per year. People who save in these vehicles have had over a quarter of their wealth eroded in the last decade alone. It's a massive crisis, and it's something the government have highlighted very, very recently. You're all probably seeing the news about, them trying to encourage more people to invest. You might think that high savings balances are a great thing, but to be blunt, what it means is that we have a massive portion of Irish households which are becoming poorer and poorer and poorer as time goes on because they're not getting their money working for them. And that money is just being eroded by continued rise of the cost of goods and services. So if you think about somebody who's saving in a bank account over 10, 20, 30 years versus somebody who's investing their money over 10, 20, 30 years, the person who's investing is going to have a much higher capital value at retirement, therefore be, a lot more financially comfortable. And obviously a wealthier society in Ireland, contributes into, a healthier economy and etc., which is why the government are looking at it so much. And so please don't become part of the problem and get your money to work for you guys. Now, in terms of the options that are available to you, even if you can't commit some of your money to a longer term investment plan, there are better options than just sticking it into a credit union or Irish bank account. And I would encourage you to look at options like Raisin. Raisin are fantastic. They basically allow you to access about 25 different European banks, which pay much higher interest rates than the Irish banks. These banks are all regulated and licensed EU banks, so they have to jump through the same hoops that the Irish banks have to jump through. It is extremely difficult to become a licensed and regulated European bank because once you get that license, you can provide goods and services to anybody within the Eurozone, hence why we can access these banks. So how you go about it is you set up an account with Raisin, you transfer some money over to it, and then you have an option as to whether you want to put that into a demand deposit account, which is an account that you can access at any stage. Raisin are actually giving an introductory rate of 3.1% for new money. However, that's only payable for the first 3 months. And then the next best option is usually some of these Swedish banks, which are paying rates of 2.08. So over the first year, you could say that you might get a rate of about maybe 2.4, 2.5% on average. You compare that to the average rate among Irish banks, which is 0.13%. You're talking about nearly 20 times the return just from you taking 10 minutes to move your money over to a higher interest paying account. These are accessible at any stage, and the banks are AAA credit rated banks. That's a higher credit rating than any Irish bank, I'll add. It's the highest credit rating a bank can have. And because these banks are EU regulated banks, they're covered under the same EU deposit guarantee scheme, which ensures the money up to €100,000 per deposit. Exact same situation we have here in Ireland. They also have some fixed term options. So if you wanted to lock your money up for, say, 2 or 3 years, you can get rates maybe 2.6, 2.7%. So loads of great options there within Raisin. So for that short-term savings, I would encourage you guys to look at this. Why it doesn't make sense for longer term money is because once you deduct your dirt tax, you're still losing value relative to inflation. Not as much as sticking it into the credit union, which you shouldn't have any money in, by the way, because they pay 0% interest, but still losing value. So for kind of longer term money, we do need to look at investment plans. And looking at investments does not mean that you can put your money into something where you look at it tomorrow and it's all gone. Investment risk can be controlled and it can be measured, and there are different levels of investment risk. Diversification, of course, is very important, which is why I was telling people not to have all of their money in company shares. But generally, investment funds can get you returns of about 5 to 10% per year on average over a longer period of time. They are accessible, so you don't need to lock up your money. They benefit from compound interest, which is described famously by Albert Einstein as the eighth wonder of the world. It's this kind of snowballing of interest on top of interest on top of interest. And over time, they generally do beat inflation, which is what we're kind of trying to achieve. So a couple of years ago, we set up something called the Alpha Savings and Investment Club to kind of educate Irish savers on the better options that are out there in the Irish market to get their money working for them. And we use some of the best savings plans in the market, which allow monthly contributions from 100 a month or lump sum investments into accounts that have very low fee structures and great performance. One of the funds we use is a fund from Zurich called the Prisma 5 fund, which has a very long-term track record. It's a very diversified fund. You can see here that it is well over 500 holdings within it. So that includes things like stocks and shares from hundreds and hundreds of the world's biggest and most profitable companies, alternatives like silver, gold, copper, steel, etc., commercial and retail properties, as well as government and corporate-backed bonds. You can see some of the top 10 stock holdings within the fund here. So companies like Google, Nvidia, Apple, Microsoft, these companies aren't going out of business anytime soon. And even if they did, there's hundreds and hundreds of more companies within the fund to reduce your exposure. A typical fund might only have about 2% exposure to any one of these companies, even within the top 10. This fund over the long term has been averaging over 10% per year. So it's a really great way to get your money working for you over a longer period of time. There are years, of course, where it'll fall in value, but history has shown that long-term investors that leave their money in the markets over time will generally be rewarded, because every downturn in markets has been temporary and it's always gone on to reach a net high each time. So the longer you can leave it there, the more you will benefit from that kind of upward trajectory. And this does extend to your pensions as well. So we can offer advice on everything we discussed today as kind of a holistic financial planning consultation service, as well as giving you specialist redundancy advice. We have two great offerings within Alpha Wealth: our core service and our platinum service. The costs vary there from 199 to 349. But for anyone who is facing the prospect of redundancy, either immediately or maybe down the line, we do offer a significant discount on that consultation fee, which is once off. So it's just an all-in fee of €99, and you can avail of that if you use the code 99redun when you're booking in through our website, or else you can get in touch with myself after and I can give you some advice around that. And just before we open it up to some questions, I just want to mention two excellent events that we do have coming up. On the 5th of March, my colleague Nick will be running another webinar, which is all about kind of achieving financial independence early by 55. So it's based around the concept of FIRE, financial independence, retire early. So for a lot of people on the call today, it might be a good one to get onto. We'll be talking again about, investment options and reducing tax, reducing expenses, avoiding short-term debt, and getting your money to work as efficiently as possible to hopefully allow you to retire as early as possible. And then in May on the 19th, we are running a fantastic event in Páirc Uí Chaoimh. We ran a version of it last year in the Riverlea Hotel. It's called Motivate, Prepare, Empower. It's a motivation and leadership event. We have some fantastic speakers this year, including Conor Neeland, Peter O'Mahony, Sonia O'Sullivan, and Bernard Jackman. And if anybody's interested in attending that event in the Páirc Uí Chaoimh on the 19th of May, they can register and purchase tickets through alphawealth.ie. we are running a sale, an early bird special on the tickets for the next couple of weeks, which is a reduced cost of 99. So just to wrap things up, we'll just go back to the questions, Lorna, and maybe answer any ones that we didn't get to.
Yeah, I appreciate we answered quite a few within your slides. There's one particular question that has come in. There's someone considering doing AVCs into their current scheme, but they're potentially facing redundancy. What's your advice? Should they consider to do AVCs through their employment scheme, or should they look at a different vehicle for AVCs?
AVCs will naturally get you the best bang for your buck because if you're a top rate taxpayer, if you think about every €100 that hits a savings account or an investment fund, that would only cost you €60 being invested through an AVC because you get 40% tax back. So for the same cost of 60 going anywhere else, you get 100 in the AVC, and then the money grows tax free as well. So irrespective of whether you're being made redundant or not, everybody should be making AVCs because normal pension contributions probably aren't going to be high enough to build enough of a fund to allow you to retire comfortably. But then it comes down to your personal situation as well, because the downside about pensions, which I'll be honest about, is that the money is locked up till a later stage to at least 50. So just make sure that you have enough money to cover for kind of shorter term needs and you are, I suppose, focusing on other financial objectives with other vehicles as well. It's a bit of a balancing act between saving, investing, and pension.
Perfect, thank you. A question has come through about transferring your employer pension scheme. For example, could you transfer, we'll say, 50% of your scheme to a provider and leave 50% where it is? In this particular case, the funds are currently with Willis Tower Watson. I don't know if that kind of dictates where your advice will go.
So firstly, you can't, if you're moving a scheme, it needs to be moved in its entirety. But secondly, I just showed you a graph earlier which indicated that the Willis Towers Watson funds are significantly underperforming versus other funds that are out there. So the bigger question is why would you want to leave 50% of your monies in funds that are underperforming when you could get them over to market leading funds? But yeah, it's not possible, unfortunately, to split pension funds. Again, happy to give you a bit of advice on that. Look, if you want to tie in with me after.
Could you just reconfirm as well, in terms of waiving or non-waiving your right, the effect that that will have on your 25% or your, we'll say, 200k lifetime limit rule, just the effect that the waiving of the right or not will have?
Yeah, so to be clear, I suppose, let's say if I had a pension pot that was worth 200,000 and it related to an employment that I got a redundancy from and I signed a waiver giving up my right to the pension lump sum, what would happen in that case is all of it would have to be used to purchase an annuity or an ARF, which is like the post-retirement kind of vehicles that I described earlier.
Perfect, thank you. The banks that you mentioned in terms of, we'll say, kind of short terms or good vehicles to use for earning interest, are those European banks or should you be looking elsewhere?
Yeah, they're all European banks. Yeah, as I said, within the European Union, we have this passporting thing whereby if a bank becomes licensed and regulated, it's allowed to enter the ecosystem here so they can provide basically deposits and products. And this is more common than you know. I'm sure most people on the webinar today have a Revolut account. Those monies are actually held within a Lithuanian bank account. So it's just becoming more and more prevalent, which is great because we know that the Irish banks are pretty greedy and slow at passing on any decent interest rate. So yeah, it's well worthwhile looking at some of those options through raising. There are some other ones like, Trade Republic and N26 and Bunk, but in my opinion, raising are the best because they get you access to the best rates and you can also offer you can access 25 different banks. Whereas if you're with, let's say, Trade Republic or Revolut, the rate is the rate.
Perfect, thank you. Just one question on the Alpha Savings and Investments Club. I suppose first off, the best way to get in touch, and second off, what funds are available, or I suppose the best thing is probably reach out about the finer details, but can you just maybe outline the best way to get into the club, and how to go about it?
Yeah, I suppose you can drop us an email. My contact details. Yeah. So look, my contact details are there on screen if you want to drop me an email at dlooney@alphawell.e, or even book in for a kind of wider consultation through our website. You can book a slot directly into my diary, where which we can give you advice not just on investments, but everything, and kind of map out this financial plan for you to help you achieve all of your goals. But being an impartial provider, we can provide access to hundreds and hundreds of different funds from all of the main fund managers in Ireland. Prisma 5 is one popular fund we choose, but there are different funds of varying risk and reward levels. So the fund that we ultimately choose will be dictated by what your needs are, and more importantly, the time frame that you have ahead.
Perfect, thank you. I think we've covered the majority of the questions there.
Perfect. So just to say, look, thanks everybody for your time. I hope you got some benefit there. We are around to, help and assist people beyond the webinar if they'd like to get in touch. And just to say, look, irrespective of what side of the coin you find yourself on when it comes to redundancy, look, I wish you well. And look, yeah, best of luck for the future. And look, if there's anything we can do, don't hesitate to get in touch.